All right. One of Citi's top strategists prefers big tech and growth over hot cyclical trades. Stuart Kaiser is the firm's head of equity trading strategy. Stuart, welcome back. So you think the tech trade has legs?
Yeah, we do.
Just a lull.
We do as a base case. I think the experience here is that you entered the year with a lot of policy uncertainty, a lot of recession risk, and I think that pushed people into large cap tech and growth. You talk to most investors, they still have that recessionary outlook somewhere. We have it in the first half of next year. So I think what that means is these moves into cyclicals, though they might last, 2 to 4 weeks, they ultimately peter out because the data is probably going to be a headwind for them on a go-forward basis.
Do you believe that the recessionary fear is still out there? I mean, is that important, or is it just that the perception is out there?
I think it's still there. I mean, if you talk to investors, it's still somewhere in their forecast period. And, if you're at a long only and your economist comes to you and says there's a recession in the next 4 quarters, you're going to invest accordingly to that. If you look at the distribution of mutual fund betas, for instance, it's very, very wide. You still have some that are sort of bought into this defensive recessionary bit, and you have some that are in the FOMO camp and are kind of being pulled up. So I think that what it tells you is that there's still an underlying kind of negativity or conservatism in the market that can be scared out of it.
We talked for like the first 15, 16, 17 minutes of the show about how some of these big cap tech names are just overvalued at this point in the trade. And so how do you sort of judge the risk reward at this point, even if you believe the tech trade is going to continue and have a little bit of legs? I mean, the downside seems to be great if the Fed indicates that, the cyclical trade is on.
Look, I think you have the right term there. It's risk reward. Valuation is something that really impacts your investment over a much longer, time horizon, but it does create risk reward. Obviously, the risk reward in tech is not as good as it was even a month ago at valuation at these levels. But we always view valuation as potential energy, and you need something to release that potential energy, whether it's cheap or whether it's expensive. So in this case, what would get people out of tech? It would probably be a significant drop in recession odds and a reacceleration in economic growth. As I said, we think there's a limiter on that, at least, for the next 3 to 6 months.
Stuart, how about the parts of the market that would really actually be most on pressure if we are in a recession? I think you can make an argument that mega cap tech could be defensive. Discretionary, consumer discretionary, some places where you've had people like a Nike or Lululemon, where there's been such, an extraordinary. I'm actually short Nike, so I'm talking book on this one. But I just think of the one part of the market that really looks most vulnerable, it's probably right there.
Yeah, I think that's right. I mean, if you think what's going to get us into a recession from here, we've already had a significant slowdown in the industrial side of the economy, IP, ISM, things of that nature, right? So to get you into a recession, it probably needs to come from employment and the consumption side of the economy. So I would agree. Anything that's consumer spending, especially discretionary spending facing, is what you need to kind of be worried about most from our perspective. Yeah.
Valuation concerning whatsoever in terms of just the broader market. Market's probably trading close to 20 times next year's numbers. Assuming those earnings numbers come in, does that concern you at all? Because historically, 17 and a half is where we should be.
As I mentioned, risk reward wise, yeah. I mean, the risk reward profile of the market isn't as good here as it was, 1 to 3 months ago. But is the valuation being there a reason to be, selling the market? I would say not necessarily until you see the catalyst or the data that should get you out of that. So am I an aggressive buyer at these valuations or for a longer term holding period? No, I'd probably be careful and kind of leg my way in. But it's not something that's going to make me get out of the market from these levels personally.
So, Stuart, what are you thinking about where the Fed is, and are they relevant at all anymore into this part of the tech part of the market near the end?
They're definitely relevant, but even if we look at options pricing, markets are pricing about a 1% move between last Friday and the Fed day. That's the smallest Fed-related options move we've had since November of 2021, which is when we first started talking about eventually stopping QE, right? So you're going, way back in time. It matters. I think to all y'all's point, what is the Fed going to do to scare you out of the market at this point, right? I think the market's expecting a hike in July, probably a skip in September, leave some residual odds of a potential another hike in November. If we come out of it with that being the outcome, I think that's neutral to modestly positive for the market. If the Fed tries to skew very hawkish and starts to talk about like long-term neutral being structurally higher, I mean, there are ways they can impact the market. But I think the base case going in is it's going to be kind of a neutral to modestly positive event in our view.
So, Stuart, I have to ask you this, and I know it's a different part of the House, but Citi's view is 4,000 on the S&P 500. Some viewers at home probably like, Stuart, he doesn't sound like he's hair on fire or anything like that. But do you see a scenario? I mean, are you trading for a scenario in which the S&P has a decline of 500 points by year end?
Look, I think to get there, the bear case is clearly linked to earnings, right? So you would either need to see earnings significantly decelerate in the second half of the year, or something to take 2024 numbers, significantly lower. So I think it's really an earnings recession that people were worried about, and worried about our house view is about $217 EPS for the second half. I think if you were there or lower, then you could get some pressure on the markets. So, yeah, it has to do with what does the second half print, and does whatever's going on in the second half have a meaningful impact on 2024. So I think that's probably how you'd have to get there from here.